But the reality is you've had wars, trade wars, you've had fiscal stress. You think that we're underpricing some of the tail risks?
I'm not expecting political stability. I'm just saying political instability is impossible to forecast ahead of time. If you look at who's been right, markets or experts, every single time, markets have been right and experts have been wrong. If anything else in the last 4 years, I've learned to think a lot less about what experts think about the economy and a lot more what the market is building in an expectation, because I don't think experts have any idea what they're talking about anymore.
Welcome to You're in Business. My guest today is Aswath Damodaran, widely known as the Dean of Valuation. He's a professor of finance at the Stern School of Business, NYU. His work has shaped how the world thinks about markets. Welcome to the program. Where do you see the biggest risk of potential disruption for the global economy today?
I think AI is lurking, but it's more of a long-term question. But I think it's unquestionable that right now what we're seeing is a rolling back of what for 4 decades we assumed would be unstoppable, which is globalization. I think we are seeing the rolling back of globalization for good reasons and bad reasons. And the global economy now has to adjust to the fact that more countries have to be willing to accept local markets as the drivers of the economy. You cannot be dependent on an outside market for your growth. And that is going to be a tough adjustment for some countries.
What did you make of what the Federal Reserve did in terms of cutting interest rates by 25%, 25 basis points? That was widely telegraphed and widely expected. Did you pick anything up specifically from the language and the context he provided?
It's the biggest non-story of the year. I mean, to me, of all the things that's happened in the last few months, this is the least critical. I know in the background there is this question about the Fed independence, which is a bigger issue. But this by itself, neither make nor break the market.
So whether the Fed cuts 3 times or 6 times or 8 times over the next 12 to 18 months, you don't think is relevant, even though, you could argue that the substantial amount of mortgages are tied to what happens there, right?
That's not true. No, that's not. In fact, I would argue the Fed funds rate, which is the only rate the Fed controls, has less and less effect on the economy. Maybe 40 years ago, when the prime rate and the Fed funds rate were driving a lot of interest rates, today mortgage rates are not driven by the Fed funds rate. They're driven by long-term treasury rates, which are set by demand and supply. And you know what? The last few times the Fed has done things with rates, the treasury market has had a mind of its own. It's driven by expected inflation, expected real growth. In fact, I've described the Fed as the Wizard of Oz. And if you've ever seen the movie, The Power of the Wizard of Oz came from the perception that it had power. In truth, the Fed has very little power. We just endow it with this power because it makes us all feel better. If we know that there is this grown-up in the room who can drive rates and set the economy, it makes us feel comfortable. But the truth is the Fed is a follower, not a leader. It follows the market in setting rates. And I don't think that in the long term, this is going to have any, even in the short term, that this is going to have much consequence. Even at the interest rate level, we look at the treasury rates today, not much of an effect of the Fed changing rates. And my guess is that will continue to be the case.
So you're not worried about cost pressures and the Fed losing control of either a healthy labor market or what consumers have to spend at the pump or at the shop?
I'm always worried about the real economy. What I'm saying is the Fed has very little control over that. I mean, it's going to be reactive. The Fed can't make the real economy look good if it's not doing well. It can't make it look bad if it is doing well. So in effect, we're giving too much power to the Fed to drive the real economy. Of course, I'm concerned about inflation, and I think we all should. And I think the most unhealthy aspect of this focus on the Fed, this is recent. When I first came to the market in the 1980s, if you asked me who the Fed chair was, I probably could have given you a name. Then asked me who else was in the Federal Open Market Committee, I would have blanked out. Because the Fed didn't have the centrality it's had since 2008. And I think it's very unhealthy because it's precisely for what you talked about. We should be focusing on the real economy, on inflation, on real growth, on how the economy is doing. Instead, for 17 years, since 2008, we said, let's turn that over and just look at what the Fed Open Market Committee is doing this month. I think people have lost their minds. It's insane.
Yeah, I mean, it can get a little bit OCD with the Fed fanatics out there. But in terms of how this frames and sets us up for U.S. equity markets, and I know you get this question a lot, but obviously your view can shift, over a week or two. So as of today, are we in a bubble in U.S. equity markets?
I don't like using that word because it comes with a sense of arrogance. Bubble basically says, I'm the smart one. I'm the rational one. Look at these crazy, shallow people pushing prices up. Are U.S. stocks richly priced? Absolutely, by every metric. Price earnings ratios, just looking at the level of the index. But I'm not willing to draw that jump and say, okay, it's a bubble, because bubble essentially means there's a correction coming. And here's why I think we've got to give the equity market some slack. First, if you look at U.S. company earnings, not just in the last year, but over the last 15 years, it's remarkable how U.S. company earnings have become far more resilient. It's almost like companies have learned to keep earnings going in the midst of crises, in the midst of changes around them. Barring the COVID correction, which was understandable, the entire economy shut down. And even then, think of how quickly earnings came back. So the first force that's driving the market is that earnings have continued to grow this year, in spite of all the negative talk, in spite of all the tariff talk. And 75% of U.S. companies have beat earnings expectations this year. So as analysts have expected lower earnings, they've beaten the expectations, right?
But the expectations have been coming down a little bit, haven't they?
Not by much, though. They're 0.7% drop in expected earnings in the aggregate. Are there individual companies where earnings have come down? Yeah, there probably are. But I think what we're missing is in the aggregate, remember, two things happen. One is larger companies are going to be weighted more than smaller companies, as they should be. And the largest companies in our midst are the big tech companies. And the big tech companies, because of their economics, incredible unit economics, incredible gross margins, are the most adaptable of all companies. They can roll with the punches, as they've shown. The midst of COVID, they were reporting higher earnings. So what's happened is if you look on a market-weighted basis, U.S. company earnings the expectations didn't come down by much, and they're beating those expectations fairly significantly.
Yeah.
So I think that's the first and biggest force keeping markets afloat. So what I would be looking...
So just to extrapolate from that, so within the Mag 7, what do you like most? I mean, you said that, the whole group has surprised you on the upside, but is there a standout, or if you had to buy a few today, you'd buy all of the 7?
I own 6 of the 7, so I owned them for a while, right? But I didn't buy them in 2022 or 2023 when they were already getting to a point where I'd say that's richly priced. But Microsoft in 2014, NVIDIA in 2018, and none of those did have the foresight to see what actually drove up the prices. I didn't see the success of cloud in Microsoft. I just happened to buy it because it's an undervalued software company. Now it's really a cloud company with software business on the side. I own 6 of the 7. The only one of the 7 that I don't own, I sold in February, which is Tesla. And of course, in the last couple of weeks, the stock has been in an incredible tear. But I have no regrets. I have no regrets because I sold it not because I didn't like the company. I really like the company. And if there's a CEO who can actually reframe a $1 trillion company from being an electric car company to a robotics company, hey, guess what? Elon Musk is it.
Yeah.
The reason I sold the company is it become a political play. And I'm not comfortable with political plays. I'm not comfortable with the company that's at the heart of politics because I'm not good at forecasting where the political winds are going to blow. So I own 6 of the 7. And if you are entering today if you've never owned the 7, you've already put yourself at a disadvantage, right? It's almost impossible to beat this market without owning any of the 7.
Yeah, you've described NVIDIA, for example, as one of the best run companies perhaps in the world. And that is actually not necessarily a good thing because of all the pressure that's on top management to deliver. What do you make of what they're doing today and sort of handling that?
You know what you want as an investor? The best run company in the world where everybody else thinks it's an average company. That's your idea. The problem with NVIDIA is it's a best run company, but the rest of the world thinks it's not just best run, but it's the best run company of all time. That's what's being priced in. Investing is a game of expectations. And you're right. NVIDIA is set up to deliver return, growth that it cannot deliver in the long term. I know, and I have a feeling NVIDIA knows it. I have a feeling that, and Jensen Huang, you got to give him credit, has never been shy about talking about things that the market is, over expecting from the company. So my guess is you're going to see some bringing down of expectations. Hopefully for NVIDIA, this is going to happen more gradually, because if it happens quickly, you're going to get a fairly significant adjustment to a $4.4 trillion or $4.5 trillion company. But I think it is a great company, but the market also thinks it's the greatest company ever. So I'm not sure it's a great investment. In fact, I think as investors, we need to separate what we think about companies and what we think about investments. I sold half of my NVIDIA position last year. And I sold it because I said half of my position, and I'll talk a little bit about why only half. And one of the companies that I bought with that half happened to be Intel. If you think about the chip business, I bought the two companies at the opposite ends of the expectations, spectrum. A company where markets believe you can do no wrong, and a company where markets believe you could do nothing right, which is Intel in September of last year.
Yeah, and I think that's. Sorry to interrupt, but we'll get to Intel a little bit later in much more detail. So I want to save that for then, and get to your kind of valuation model, because they assume a degree of political stability, right? But the reality is you've had wars, trade wars, you've had fiscal stress, you have U.S. election uncertainty. You think that we're underpricing some of the tail risks, and we should be re-rating some of the valuations. I mean, because of how fluid 2025 has been in particular.
Let me reframe the question. I'm not expecting political stability. I'm just saying political instability is impossible to forecast ahead of time. It's the same thing I would say about any kind of uncertainty. But you have a good point. Maybe this is an instability where there's far more downside than upside. It's kind of it's not a great distribution as an investor, right? You want upside to be in your favor. The tail is on the downside. And there's an argument that maybe the market is not building in enough of the downside into its pricing of equities. That's an argument we've been hearing since March, or April of this year when the tariffs came into play. You're saying there's not much upside from this. There's so much downside. Why isn't the market doing what we'd expect it to do? And this is, you could take this back 4 years. I remember hearing this during COVID. It's, exactly the same argument. And in fact, for the last 4 years, you could replace the macro worry you have and have the same argument. At the end of the process, though, if you look at who's been right, markets or experts, every single time, markets have been right and experts have been wrong. If anything else in the last 4 years, I've learned to think a lot less about what experts think about the economy and a lot more at what the market is building in an expectation, because I don't think experts have any idea what they're talking about anymore. And if you consider me an expert, I would include myself in that group, because we're like those French generals leading into the Second World War who'd built the greatest defenses ever based on what they saw in the First World War. And the Germans just used tanks to go around it. We're all fighting the last war. The next war is going to be so different. And the market at least is trying to look ahead.
What about the downgrade of U.S. sovereign debt? That event has forced a fundamental rethink of what has been a traditional risk-free benchmark, right? Because that's what you're pricing off of.
Show me a market number where there's been a fundamental change since May 16th of 2025. Did treasury rates jump?
No. But I'm asking the question whether that's right.
But if it's fundamental, right? Fundamental in experts' heads, right? We think this is immense, this is huge. And the market say, not so fast, we knew this was coming. This is, again, I think the disconnect. We tend, and I think part of the problem is we have 24-hour business news. We have to fill it with expert commentary. We have to talk about things, and we bring things up to the surface. This is the biggest thing ever. The market has to react to it, and the market blows by it. And our reaction is market doesn't recognize what we do because we're the experts. So if there's been a fundamental rethink since May 16th of 2025, I can't think of a single number. Take the number which should be most fundamentally affected, the sovereign CDS spread for the US. The market set number for demand and supply. You know what it did? The day after the Moody's, it actually went down. because basically the market said, hey, this is a slow motion demotion for the US because S&P went first in 2011. Fitch went in 2023. Moody's was the last ratings agency standing. And they lowered the rating from AAA to AA plus. And market said, what took you so long? Right. There is, I think, a psychological barrier that was crossed on May 16th of 2025. And that's, I think, worth talking about. As investors, we all want, as human beings, we want safety, right? As kids, we go to our parents. And even as grown-ups, we need a safe place to be, family, friends. And as investors, we seek safety. We want a safe place to go when there's a crisis. And for a century now, almost since at the end of the Second World War, that safe place has been U.S. Treasuries. Every crisis, what do we see? We see U.S. Treasuries being our place to go. What this took away was that fig leaf, because it was a fig leaf. Even well before May 16th of 2025, the U.S. Treasuries were no longer the safety zone that you thought they were. Now we no longer have that fig leaf. And that psychological anchor is critical from a behavioral perspective, because in a crisis, you have no safe place to go. It makes you more panicked.
I mean, you have higher yielding alternatives available though, right? So it could be Saudi Arabia, it could be India in terms of, a benchmark for
higher yielding in dollar terms. India doesn't issue dollar-denominated bonds. So we're talking about rupee because we're comparing bonds in different currencies.
Well, we focused in on Saudi then, so the Saudi dollar bonds in this case.
And that's true. You could buy Saudi dollar bonds, but if the U.S. defaults, do you think the Saudi dollar bond is somehow going to be the safe bond to be in?
No, I don't.
Yeah. So in a sense, if you want to pick a Swiss franc bond, I mean, there's an argument to be made that if you want true safety, the problem is the Swiss franc bond market is not big enough to be a safe zone if the entire global market is in crisis. It's not designed to be a crisis investment. It's not large enough. So if you look at any other alternative, and there are only 8 countries left in the world with AAA ratings, you don't have a lot of choices, right? Are you going to buy the Canadian bond? How about the German Euro bond? It looks like every other one of these countries
maybe others would.
It would, but they're all at tipping points as well. I would not be surprised if there's one AAA rated country left in 5 years, and that's Switzerland. Everybody else has lost their AAA rating. In fact, after the 2008 crisis, I wrote a series of what I call nightmare papers. Papers of, what if we woke up tomorrow and this was true? And one of the papers, what if nothing is risk-free? That was the paper that was a hypothetical in 2009. We're closer and closer to a world where there might be nothing that is truly risk-free. And that's psychologically very scary.
It absolutely is. I want to get to some of the stocks outside of the United States. In China, you have Alibaba's rebound is nothing short of incredible, soaring about 90% so far this year. How do you view that opportunity set, and what would you tell anybody looking at that?
No, I told you about I sold Tesla because it had become a political stock. It's for that very reason I avoid almost every Chinese company. I've talked about how when you invest in a company, you're investing in a story. You'd like that story to be about the company, whether it's Palantir or Amazon. But with a Chinese company, that story is an actor in the room that you don't control, which is Beijing. No matter how big and how powerful and how successful a Chinese company is, Beijing is in the room. I mean, you saw this in 2019 when Beijing took their biggest tech companies into a closed room. And when they emerged, they'd been cut off at the knees. Tencent, Alibaba. In fact, that was the start of their collapse in market cap. And how do you know that won't happen in 2026 or 2027? I mean, that is my concern with these companies is you're not investing in a company, you're making a joint bet on the company and Beijing, and I'm not comfortable doing that. You could argue that this is becoming increasingly true across the world, that you invest in Intel,
that was going to be my pushback is in the United States.
That's going to make investing a lot
everybody.
More. Yeah. I think it's going to make investing a lot more difficult to do because it's making investments in companies this joint bet, and I've never been comfortable doing that. And maybe I have to learn to become comfortable, and that'll make Chinese companies. In fact, it's interesting. I did when I sold Tesla, just as I replaced NVIDIA with Intel, I replaced Tesla with BYD. First Chinese company.
So you still hold BYD?
I hold BYD. It's not done great. In fact, looking back, he's saying, why did you leave your money in Tesla? Because I think from a political risk perspective, I feel BYD is less exposed to political risk than Tesla is in a strange way. So this might be something we have to factor into every company, which means every investor now is to become a political prognosticator on the side. And that's not a great place to be for investors.
Any other markets or stock specific outside of the U.S. if somebody wanted to, to diversify away from, because you've made the point that they're richly priced. So if I want to find other opportunities, where are they? What are you looking at? What's on your list?
I mean, let's step back. If we go back before 2024, the conventional wisdom was international diversification has failed. That if you put your money in the S&P 500, you'd have beaten almost any globally diversified portfolio. That was absolutely true, through much of the century. And then people made a jump and said that must mean you can be domestically invested. That's okay. I think 2025 is a reminder that time in stock markets is not in years, not even in decades, but often over very long time periods. When you ask people to invest internationally, it's not because it's going to make them better off next year or even the next decade. It's for the long term. And I think we became underinvested in the U.S. as U.S. investors over the last 15 years, sometimes because our U.S. stocks went up so much and our foreign stocks didn't, that we went from a 20% foreign stock holding to a 5% holding. We were okay with it. So I think it's time for investors everywhere, but especially in the US, to look outside the US and bring stocks in. I think Europe is full of boring, not great companies, but it's also full of boring, not great companies that might be good investments to have in your portfolio. So I think Europe, and I will let people make their decision on what parts of the market they're comfortable with. If you're going after mature companies, Europe is the place to be. If you want to go after growth companies, you probably have to go to Asia and Latin America because that's where the growth is. You're not going to get too many great growth companies in Europe. But I think it's time you enrich your portfolio by looking outside the US. My last 3 investments, 2 of them were non-US. One was BYD that I talked about. The other is Mercado Libre. Mercado Libre is Latin America. I mean, people describe it as the Amazon of Latin America, but it's well beyond that. It's not just an online retail company, but it's also a company that's becoming a financial service giant in Latin America and essentially providing banking and investing services that I think threaten traditional banks and investment services in Latin America. So I'm looking outside the US, but luckily for me, I'm not a professional money manager. I don't have to find 50 stocks to invest in. If I can find 3 or 4 or 5 companies each year, I'm okay with that. That's all I need. But I think that's where I would be looking next.
I mean, the Middle East has gone through a lot of reform in the last 2 years to try and bring more capital in. And sort of Saudi Arabia, the United Arab Emirates, they've kind of led the charge. I wonder to what extent, from the vantage point of you being in New York and obviously Mag 7 expert, and sort of, you just said, a brave jump for you was already going to China and you're not even sure about that. So I'm wondering where the Middle East fits into that, be it the UAE or Saudi Arabia, maybe even Egypt or any of the other countries. They have good companies, but I'm using the UAE and Saudi Arabia. Maybe Qatar is would be the third one to put in there because they've done the capital markets reform and you can easily buy stocks from, your preferred brokerage in New York City. So could you talk to us about that a little bit?
I'm going to tell you a story that has nothing to do with the Middle East as to why I think the Middle East is going to struggle to get its capital markets flying. Now, a long time ago, I was in Singapore and I was talking to the regulator of Singapore equity markets, and I was talking about the fact that a lot of money was leaving Singapore and going to Hong Kong and Tokyo and Frankfurt. And he said, how can we make Singapore the center of the financial universe again, where people... And I said, I'm going to tell you what you need to do, but you will not do it. And he said, what do you mean? And he said, look, markets need chaos. That's the nature of markets. You need to let people overreach, correct, make mistakes, and deal with the consequence of the mistakes. You need to have disorder for markets to actually function. And I said, just look out of the window at Singapore. What do you want? You want order. You want you want Disneyland in your city, everything run. And I love Singapore because everything is orderly. But when you look for order, it's very difficult to have financial markets flourish, because what you look for in financial markets is you let people make mistakes, big mistakes. You started with the word bubble, and I wrote a piece a while ago that got me a lot of blowback saying, what's wrong with bubbles? They say, but they burst. People get hurt. But every bubble that's burst has changed the way we live as human beings. Dot-com bubble burst, right? People lost their jobs, they lost their money. But guess what? It changed the way we live. It's human nature to overreach. That's what we call a bubble, and then correct, and then say, I'll never do that again, and repeat it on an entirely different thing 5-10 years later. I think if the Middle East truly wants capital markets to succeed, it has to allow for some chaos. It has to allow for companies that go public with, don't be so protective of investors. I know this cuts against every theme you talk. If you try to protect your investors too much from bad companies, bad investments, stupid mistakes they might make, you cannot have a vibrant market. You got to allow for mistakes. You got to allow for people to deal with the consequence of their mistakes and not be so quick to bail people out or cut back on their overreaching. So maybe the Middle East will take my advice. When I go to Dubai, get the same sense that I get in Singapore. Very orderly, great place to be. But I don't know whether that is the kind of city where you're going to get a vibrant market where people make mistakes, because the need for order overrides the need for, disruption and change and the kind of chaos that always brings it.
I take your point. I take the spirit of what you're saying. I would say on the ground, between Riyadh, Dubai, and Abu Dhabi and Doha, I would say there's been plenty of failures and learnings and sort of healing. So the idea that order always trumps, I would say, is not always the case. But I also understand what you're getting at. So I think it was fantastic to hear. So thank you for sharing that anecdote and sort of what you're seeing from your travels. And then in terms of the country risk premium list, right? So you, for the last 2 decades, every year you've updated this list, and you've done your numbers. And I want to understand which country surprised you the most in that journey in terms of improvements, right? Making a positive impact, because most of the countries probably deteriorate over time. But is there one that's going up?
And that's not true. In fact, I think that if you look at most emerging markets over the last 20 to 25 years, especially the big ones, India, China, the trend line has been inexorably positive. In fact, globally, country risk has come down. There are pockets, obviously, Afghanistan, Iraq, Syria, Sudan, but the big countries, the big emerging markets have become safer over time. It's 3 steps forward, 2 steps back. Take Brazil, right? In 2012, Brazil looked like it was on the verge of becoming a developed market. By 2015, it was a basket case, right? So I'm not saying that the pathway is always linear, but overall, the trend line has been positive. But there are parts of the world where the trend line has been negative. Southern Europe. Southern Europe now is riskier than much of Asia. Italy, France. France has joined the Spain, Portugal. The outlier there is going to surprise you. The country that's moved in the opposite direction in Southern Europe is Greece. Greece has gone from being one of the riskiest countries in Southern Europe to the middle of the pack, or even the top. I would not be surprised if the Greek country risk premium became smaller than the French country risk premium sometime in the next 5 years. It would cut against every grain of lots of people's beings. But these are risk premiums in motion. Things don't always move in one direction. And there is a global effect, which is all countries can get riskier during a market crisis, 2008, 2020. That cuts across the board. But if you look at individual countries, it's up for some, down for other. Regionally, Latin America had been improving for a long time. In the last couple of years, it's had its step back, right? It's been one of those parts of the world which had the biggest improvement over a 20-year period. But again, it's 3 steps forward, 2 steps back.
We're watching out for Greece and seeing what else they can pull out of the hat in terms of reforms. And I guess inspiring skeptics is maybe a way to do it after a very painful time for the country. You recently published a book called Corporate Life Cycles. And you basically take a look at the lives of companies, as the name implies. When I was at university, one of the tenets of corporate theory was that companies live a life just like human beings have a life. So it's finite, it ends, right? And to me, at the time, that was a shock, right? So this is over 20 years ago. ExxonMobil and General Electric seemed unstoppable, right? I'm wondering what happens as they age and what they can do to adapt and maybe, just maybe, delay their fate, their inevitable fate.
The biggest enemy is scale, right? As you live and you grow, you get bigger. And as you get bigger, it gets more difficult to grow, right? It's mathematically, that is the problem. It's one thing to do in your $10 million company to grow 100% a year. That becomes more difficult when you're a $100 billion company, then $1 billion, then $10 billion, then $100 billion. The scale starts to work against you. That's the first thing. And it works against you at 2 levels. One is your existing businesses basically mature. So you're saying, what if they go into new businesses? Remember, if you're a trillion, take Apple, $3 trillion company, right? If you create a new product, think of how big that new product has to be in terms of market size and market share and profits to make a difference. And that's, I think, the biggest challenge. As you scale up, growth gets more difficult because growth is a percentage number. It's not a dollar number. You're growing at the same dollar value. The second is there's a culture that you create as you grow and succeed, and that culture helps you. But eventually that culture starts to work against you because what worked when you were successful starts to work against you. So one of the biggest challenges that older companies have in reinventing themselves is what made them successful in the first place starts to get in the way. So if you look at the truly successful reincarnations of they're very rare, right? Microsoft in 2014. And I still admire what Satya Nadella did, which is he said, look, we're an aging company. We have 2 successes, and that's all we've had, Office and Windows. We need to do something different. And you can also see, if you think about the internal culture of the company, this was a company that made all of its money from Office and Windows. And those people who ran those businesses were very protective of those businesses. They felt that they were the center of the universe. So in most companies, when you create a new business, guess who would have veto power over what that new business would do? The existing businesses, because they provided the cash. What Microsoft did that gave it a chance at reincarnation was, first, it didn't go out and acquire a new business. Because already when you go out and acquire a new business, you ask for trouble. You pay a big price up front. You bring in a new culture in. He built a new business from scratch, and he essentially insulated it from the Office and the Windows. People saying, build your business. That's really tough to do for a CEO. But he pulled it off. And the reason I said that alone doesn't create success is you need ingredient that none of us like to talk about in business school. The biggest ingredient in success is being at the right place at the right time. It's luck. We can't manufacture it. We can't put it into a case study. And sometimes being lucky overrides every other thing that you do. So when you think about the ingredients that companies have, first, they've got to figure out a way to break out of scale by going into new business that's big enough to make a difference. Second, to build that new business without overpaying and without creating cultural wars within your company. And third, hoping and praying you get lucky to be in the right place at the right time.
Wow, that's incredible. I think what also caught my eye is that the shape and timing of life cycles actually varies across industries, right? So it's not one set path for everybody, right? Could you talk us about the differences that you've picked up there?
I'll give you 2 contrasts. GE went public in the 1890s. And I would put GE's funeral around 2021, 22. Now there are vestiges, broken out pieces, but GE lasted as 130 years. It took them a long time to become a big company, 50, 60 years. They lasted at the top for a really long time. And then they decayed gradually over time. 2 decades, maybe more. In contrast, think of Yahoo, founded in 1992, $100 billion company 7 years later. What took GE 60, 70 years to accomplish, Yahoo accomplished in 7 years. That's still lure of tech companies, right? They can go from nothing to hundreds of billions of dollars essentially overnight because they can scale up quickly. They lasted at the top maybe 5 years. We know exactly when their debt spiral began is the day Google went public. You essentially saw the end game begin for Yahoo. By 2015, the company was done. 23 years from start to finish. The typical 21st century company is more like Yahoo than GE. Unfortunately, everything we know in business, everything we teach in business schools, including what I teach in my valuation class, is designed for the 20th century company. Companies that live forever. I mean, I'll give you the very simple mechanic that drives it. And when you value a company, you project out cash flows over a period, 5 years or 10 years. At the end of 10 years, you estimate what you think the company will be worth at the end of the 10th year. So how the heck do you do it? We make an assumption that the company will continue in perpetuity. And then math helps us out because in perpetuity, it becomes it becomes an infinite series. You can come up with a number. Yeah. When you have a company like GE, that assumption is not a big deal because the difference in 80 years in a perpetuity is very small. But 25 years in a perpetuity is huge. So maybe we need to rethink so much of what we talk about and teach in business schools for the 21st century company. And I don't see that happening out there.
You think that there are far too many companies who are refusing to face aging, to basically be in a position where they say, we don't want to shrink, we don't want to shut down, we refuse to accept the clients. So you kind of put your head in the sand. Are there any companies that come to mind today that you see that are in this position?
So let me ask you a question. Who runs companies? Human beings do. So let me generalize your question. How do human beings deal with aging? What do most of us do? We fight it, right? We fight every step. We put dye in our hair. We go to plastic surgeons. We hire physical trainers. We think we can reverse the process of aging. I mean, there are these tech billionaires now who are paying tens of millions of dollars trying to extend their lifetimes out.
Brian Johnson. I mean, he's become a billionaire from that, from selling the courses and the master class and everything.
And I think human beings just don't like to age. They want to be young. And it doesn't surprise me that most companies fight aging because they're run by human beings who think they can be young again. Forget about being middle-aged. They think they can go back to being young again. And there's an ecosystem that eggs them on, right? I think that the main business for consultants comes from companies that refuse to act their age. If you're McKinsey, this is your dream client, right? An aging company with a lot of cash says, tell me how I can be young again. You come up with little matrices and things they can do and acquisitions they can make, a new business. You make a lot of money off this as bankers and consultants. So just as your plastic surgeons egging you on as a human being saying you can be young again, you got bankers and consultants. So the world is full of companies that refuse to act their age.
I mean, look, Intel, we said we'd come back to it. They refused to act their age. You could argue they refused to act their age. And then the government bought a stake. And now NVIDIA's bought the stake after the government bought the stake. That's the breaking news right now, 30% of the company. So maybe sometimes it's okay to kick the can down the road, even if you've passed your shelf life.
No, but Intel's not going to go back to being the largest semiconductor company in the world. I said, when I bought Intel in September of 2024, I said, look, there's a niche business for this company, but it requires a mindset change, which is Intel was used to being king of the castle, the top of the heap. You need a cultural mind shift that says, we're not the leading company anymore, but there's a niche business where still the leading US chip company for some aspects of the chip business. And I have a feeling Intel's going to find that niche business. It needed to be pushed there by the government and now by NVIDIA investing in it. But this, I wager, I mean, I was in Intel headquarters in 2017 when they still thought of themselves as the leading chip company. I'll wager you walk into headquarters today and that's not the feeling you will get. That's the cultural shift you have to make when you age, is recognize you're not the company you used to be, and you've got to be different to reflect the fact that you're now a beyond middle-aged company, and you can still be successful as a beyond middle-aged company as long as you accept the limitations that come with it.
Words of wisdom there. How would that apply to Starbucks? They have the issue where their products have become quite a bit out of reach for a lot of their traditional consumers. How would you characterize how they've, quote unquote, adapted? And I do that intentionally.
I think it's not that their products have always been expensive, right? It's not as if Starbucks used to be cheap 5 or 10 years. It's always been expensive. I talked about how stories drive investing in companies. The Starbucks story is broken. It was broken partly because of things they did and partly because of external factors. Let's go back 30 years when Howard Schultz created Starbucks. He was creating a cafe culture in a country which didn't have one. The US didn't have a cafe culture. It's not like Europe. He said, we're going to create cafes in the US where people will come in and not just get coffee, but hang out, right? And Starbucks was a cool place to be for a while. Students hung out there. People did businesses there. And then COVID hit. Okay? And when COVID hit, Starbucks had to pivot and they created an online ordering business. Now, if you walk into a Starbucks, and I have a Starbucks, I have a Starbucks actually right next to me right now. I order online. I walk in and there's this online table where they have the food to pick up. If you walk into a Starbucks, take a look. There are like 30 people gathered around the online table waiting to pick up their drink. And there are like 5 people, forlorn people sitting in the cafe drinking their coffee. So what Starbucks has is an incredibly expensive infrastructure of cafes around the country where there are relatively few people in the cafes and everybody's picking up stuff to go. That storyline is now broken and they have to come up with a different storyline. And it's not going to be easy. You say, why not become an online coffee pickup place? And what are you going to do with all the expensive leases you have all over the country for these big cafes, but nobody's sitting around? That's going to be the challenge and when I look at the new top management at Starbucks and what they're trying to do, they're trying to come up with new food items. What I'm looking for is, what are you trying to do to kind of fix this story, right? You might not be able to go back to the cafe story, but what's the replacement story that I'm investing in? So while I bought Intel, I did not buy Starbucks. I did not buy Starbucks, the company, because I don't see that storyline yet.
Professor, to what extent are you including crypto plays in your personal portfolio? So a shift away from equities to alternatives. Where do you stand on that today?
To name the crypto play.
Well, I mean,
cryptocurrencies.
Yeah, so Bitcoin and or Ethereum. Let's go with kind of, I guess, relative mainstream.
Yeah, let's step back. What do investors do? What's the essence of investing? You value a company, and if the price is less than the value, you buy at that price, and you hope and you pray, and you hope and you pray that the price goes to value and you make money. That's the essence of investing, right? How you value companies, I'm completely agnostic about, but that's the essence of investing. You cannot invest in Bitcoin. You can trade it. And here's why. Bitcoin cannot be valued. And this has nothing to do with not being a fiat currency. Fiat currencies can't be valued either. You can't value the dollar, you can't value the real, you can price them. That's what an exchange rate is, based on how good or bad they are as currencies. But you can't value them. If you can't value something, you can't invest in it. You can't invest in it, you have to trade it. How do you make money trading? You buy at a low price, you sell at a high price. Perfectly appropriate game to play. It's not a game that I'm good at. And that indirectly answers the question why I would not put Bitcoin in my portfolio. It's a traded investment. And to be in a traded investment, you got to be good at detecting mood and momentum and shifts in those. And I'm not good at that. There are others who become very rich on Bitcoin. I don't begrudge them. There are other, the reason that, go ahead. Yeah. But there are other crypto plays as well, right? Crypto is a big space. You got cryptocurrencies. You got crypto assets, some tokens maybe, and companies that make money on crypto. So Coinbase, I don't own stock in, but I'd be willing to buy Coinbase at the right price because it's a business. It makes money by people trading crypto. So with crypto, I think the first thing I'd encourage people to do is don't put it all into the crypto grouping, break it down based on the type of crypto and ask yourself, am I equipped to play the game on that particular pile of crypto? So I'm not equipped to play any of those games, and none of the crypto companies right now look like bargains to me. But if they did, I'd be willing to invest in a crypto business, but non-crypto per se.
So that, I guess, extends also to Michael Saylor and his company Strategy. I mean, formerly it was called MicroStrategy.
Yeah, it's a closed-end fund. I mean, this is not a company. This is not a business. It's a closed-end fund with one investment, Bitcoin, that you buy at a premium. Why? Because you think Michael Saylor is a pricing savant. Remember, I said Bitcoin is a pricing game. So if you feel that you have somebody who's really good at calling the shifts in prices, then what do? You put your money with them and then trust them to make the right pricing calls. Now, it's not something I would do, but I'm not going to tell. I mean, this goes back to what we talked about. People have to make their mistakes and learn from them. If this is your game and you want to bet on Michael Saylor getting this right, all the more power to you. It's your money. Well, who am I to step in between you and your money? It's not something I would do. MicroStrategy is not a company. It's a closed-end fund that owns Bitcoin, and you're buying Bitcoin at a premium of 50, 60, or 80% above its actual price. Be very clear about what you're doing if you're buying MicroStrategy. You're playing the trading game on steroids.
Are you surprised that there's been so much institutional adoption of Bitcoin and now more recently Ethereum?
Not at all, because I know what drives institutions. It's FOMO. More than anything, I mean, this isn't, people assume institutions are full of these wise people who look at valuations and decide. Institutions are the biggest sheep in the investment world. People talk about retail investors running after the crowd. Institutions are the biggest crowd chasers. Their biggest worry is being out of the next big one, whatever that next big one is. So whether it's AI or crypto, they're afraid of being left off. And I'm surprised it took them so long to join in. The only reason they weren't joining in was because of regulatory constraints and what they could. It terrifies me that those regulatory constraints will be removed. And you could have mutual funds investing in Bitcoin and pension funds investing in Bitcoin and endowment funds investing in Bitcoin, because they would chase price increases in the last period and end up losing us all money.
So it sounds to me like you're saying this is an apparent regulatory failure, that this should have been stopped in its tracks, given the potential, the potential systemic risks.
Yeah, I think there's a fiduciary problem here, which is endowment fund managers, for the most part, are inept. Giving them more power is a license for them to be even more inept with your money. Now, the essence in investing is less is more. And most endowment and investment managers don't get that. Giving them more power to enter markets they don't understand. I mean, I wrote a piece on alternative investing. Just earlier this year, alternative investing was this drive towards getting VC and PE, and institutional investors started buying into it. David Swensen at Yale made this the thing to do. For the last 20 years, they've piled into alternative investing. You know what they've discovered after 20 years? None of the things they were told would happen, that they'd get better Sharpe ratios, have actually manifested. Been the biggest con job in history. And you can add Bitcoin and crypto and whatever else they'll add to the space, because that's where they're going next. Is they're looking for the next magic bullet because they want to figure out an easy way to make money. And unfortunately, there are no easy ways to make money.
Okay, with that being said, what advice would you give to those who are starting out on their investing journey? Be it younger crowds or people who are close to retirement. Even what would you tell them?
Tell them be clear about what your end game is. I think of investing as preserving and growing your wealth. Not getting wealthy, but preserving and growing your wealth. To preserve and grow your wealth, what do you first need? You need inflows into your fund, right? Where do you get the inflows? By working a job as a doctor. So if you're a doctor, an engineer, or a scientist, do your job well first. Earn an income, save portions of it, and use investing as a way to preserve and grow it. The reason I say that is that a lot of young people who are doctors who are spending their lunch breaks, rather than reading up the latest medical journals, checking out the stock pages. because to them, investing has become this quick way of getting rich. No, I'm not making enough money as a doctor, so I'll use investing as a way. That's a horrendously dangerous way to start your investing journeys by saying, I'm going to invest because it's my easiest pathway to getting rich. And once you decide that investing is a way of preserving and growing the wealth, go slow. Do things incrementally. Don't overreach. Less is more. One of the most enduring findings when people look at active investing is the more active you are, the lower the returns you make.
And the data
is more.
The data is very clear on that. It's, I mean, you can't
and
find
I'll
any
add
more
to that,
consensus on that.
The more information we get on markets, the worse our returns seem to get. So stop watching CNBC, stop consuming so much financial news, stop listening to every financial news, except the podcast maybe. But I think we spend far too much time on markets and investing and far too little time on the rest of our lives. And I think we need to fix that.
You taught and wrote now for decades. Talk to us about how your thinking on valuation and risk and markets has changed. Maybe if you think back to some of the inflection points like 2000, 2008, 2020, I don't know what stands out to you in that journey where you're like, wow, that was a moment where it was very impactful and it changed how I saw the world.
The longer you stay around markets, the more humble you get about the things that are out of your control. I mean, that's, 40 years ago, if you asked me what I thought about karma, I'd have said that's an Indian way of thinking about things. We control our destiny. 40 years later, my answer is so much of what happens out there is out of your control. And that's a healthy recognition to get, because first, it'll make you less arrogant when you win, because you realize that you got there mostly because you were in the right place at the right time. I didn't pick NVIDIA in 2018 because I thought AI was going to be a big thing. I didn't even know what AI was, at least in the form it is today. I just got lucky. So the first, and the second is it'll give you the capacity to forgive yourself when things don't go right, that you don't blame yourself, because you recognize that sometimes you can do everything right and end up losing money through no fault of your own. So to me, the biggest lesson I've learned is to accept things that happen as saying, hey, I did the best I could. And in fact, it helped me fight what I think is we talked about FOMO and how that can lead you to chase. The second biggest problem in markets is ROMO, regret over missing out. If only I'd done this, if only I'd done that, if only I'd done the third thing. And that is so damaging, because once you start to feel regret, it starts to eat into how you invest and where you invest. And I don't have much regret about, any of the things I do. I buy something and it doesn't go well. I say, okay, I learned my lesson. And I would say the same thing is going to be true about, if I do things and something goes right, I say, okay, that was good. So I think that's the biggest change.
When we go back a little bit further, what inspired you to get into finance to begin with?
I'm not in finance. I'm a teacher. I happen to teach finance. I don't think of finance as my primary passion. It's teaching. I like teaching finance because it's a mix of stories and numbers. I mean, I would be bored teaching accounting or statistics, not because those are not useful tools, but it's all numbers. It says an end game, you check. I like the fact that in finance, you don't know whether you're right. You could do everything. You get the answers. I value a company, and you say, how do you know it's right? My answer is I don't, and I have to be okay with it. I like the fact that we live in uncertainty because that's the way the real world is. So to me, it captures all of the things that drive business, and it fascinates me on a day-to-day basis.
You do a lot of writing and analysis, and I would say it requires some healthy routines to manage distractions. So I'm looking for tips here, because there's always so much noise, and the noise keeps getting more and more, right? All the notifications and more devices, and it's hard to get away from that. How do you get into your zone of focus? How do you get dialed in?
Be lazy, have a vacant mind. And I'm serious. I think much of what I write comes about because I don't have a phone with me distracting me. I take my dog for a walk without any devices, and for 40 minutes, my mind is empty in the traditional sense. I'm not listening to a podcast. I'm not reading anything. I'm not listening to something. I'm not looking up at Facebook. I've discovered that you need to give your mind some room to connect disconnected thoughts. Almost every one of my writings, if it's a blog post, comes about because I let my mind kind of let things work themselves out. Different strands of thought that connect. I tell people, look, if Isaac Newton, sitting under the apple tree, had a smartphone in his hand, was checking out Facebook, and an apple had fallen on his head, we wouldn't have the laws of gravity. We would have cursing about how the apple distracted him from reading the latest Facebook post. How the heck do you go from an apple falling on your head to the laws of gravity? That's what human minds can do, is disconnect these disconnected things and come up with what I call leaps of logic, intuition. And for that, you got to have some time to think. It's almost like technology companies have conspired to make us replaceable by AI by taking every portion of our time and filling it in with what we think is critical stuff to do. I mean, I challenge you next time you're getting ready for a flight, when you're at the gate, to look around you at what everybody's doing. Everybody's checking out their smartphones and everybody's busy in that sense of the word. Nobody has time to just daydream. So my advice to people is daydream more. Read less. No, don't be so concerned about filling your mind with information. Let your mind kind of find its own way to answers. No.
That's an inspirational way to wrap up today's conversation. So thank you so much for being generous with your time, and I hope to see you again real soon.
You're welcome.
Thank you for listening to You're in Business. If you've enjoyed the conversation, like, share, and subscribe. See you next time.